Hi, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructures. I'm the president. We're also known as Chicago Quantum, and we're registered investment advisors in Illinois. We're here to talk today about the markets. They're risk off, and that means you really have to focus. You really have to hone or forge your investment strategy to take advantage of smaller and smaller edges in the market. So it means that the return to risk is lower, so you have to be more thoughtful and more careful on what types of risks you might take in the market. So I'm going to share the model, I'm going to share some output, and I'm going to talk about why we're risk off and what it would mean to you. Well, the first thing is, and if you've watched any of our videos before, you understand, we decide whether the market is risk off by some very simple mechanics. We look at the risk-free rate of return that you can get as an investor. And we set it at 4.70%. And that's based on if you were to put your money into U.S. Treasury securities, typically short duration, 1 month or 4 weeks, 13 weeks, maybe a savings bond, maybe a bank account, maybe a money market account. And we take all that into consideration and we figure out a risk-free rate for a typical investor. Now, it's harder if you have a lot of money to invest because you're going to pay for some mitigation of risk. But if you have less than $250,000 to invest in cash, then you can put it in a bank account. If you have $10,000 to invest, you can buy a savings bond. Anything up to, I think, like $1 billion or so, you can invest in Treasury securities. And so, I think I got you covered. 4.7% is a good number. I won't bother you in the video with how I come up with it. There's lots of videos, right? The other is, when you look at the actual returns of the market, they're still negative. Now, this is excluding dividends. A dividend is like 1.5% on the S&P 500. So the S&P 500 went down 7% in the past year from a price perspective. And, actually no, I'm sorry. It went down 10% over the past year and paid you back about 1.5 points of dividends, which you pay tax on, which is unfortunate. And when you look across all these, we have a number that we use. We expect that the risk assets are going to earn 7% over the next year. We actually see the market as dropping and then going back up again. So maybe it drops 10%, maybe it goes up 20%. So net, a year from now, the actual price of stocks is up 7%. You'll still get your 1.6, let's call it, dividend yield, because we're expecting some dividend payouts to go up and stock prices to go down, and it'll pick you up. But that expected market return then is under 4%. Can you imagine investing money in the stock market, taking risks to earn 4% over and above any risk-free rate of return? That's a very low risk return. And so our model understands that. Our model is not artificial intelligence. It's not an intelligent model. It's not like some supercomputer in the basement with a brain. But it's my brain programmed into a model. And so it reflects with perfect precision, actually 1.0 times 10 to the 19th precision, what I think. And so I'm going to share with you what I think, and maybe you'll learn something. Maybe you'll like it. Let's see how we do. So, just on a technical basis, there were 10,749 stocks that traded on Friday. 10,749 tickers. That's a lot of stocks. That's a lot of tickers. Some of them were from other countries. They're listed in the U.S., but they operate in other countries. Good example, Deutsche Bank, we all know, is a German bank. But it trades on the U.S. stock exchange. It's actually listed, so it counts. We keep it in because we're trying to, keep in all this good stuff. Liberty Global, PLC out of the UK. You'll see Cosmos Energy out of Bermuda. God, we traded that stock for a long time. Cosmos Energy. I'm going to write that one down. That thing, we made a lot of money on Cosmos. But that's not the point of this video. But you see it. It's a Bermuda company. It actually operates in Africa. There's lots of companies, right? And so they're just different. So we keep them in. $2,134 stocks past data validation. Another good thing to note is that we lowered the market capitalization floor because we wanted to allow more stocks back in. So market cap floor, come on, here it is. Market cap floor is $1 billion. All right. It's not like we took it down to $10,000, right? So it's still $1 billion. But taking the market now to $1 billion means we have a lot of stocks. We have 2,100 stocks that we run through our model, and we're looking for just the best portfolio. So what is the best portfolio? I'm going to type it for you. The best portfolio. I should probably have this printed out in a report, but the best portfolio we seek is the one with the highest return and the lowest risk. Said more precisely, we look to net the largest difference between historical risk and expected return by holding a U.S. common stock portfolio equally among the stocks. So 10 stocks would each be held 10% regardless of market capitalization. That's what we're doing. It's pretty simple. We run it. It's a deep model. So we zero out our model. If you were to hold every one of those 2,134 stocks right there, your Chicago Quantum net score would be 2.71 times 10 to the negative 19th power. In other words, it's zero. To get to that, you have a Chicago Quantum net score power of 3.36. Which is low. The expected return of those 2,134 stocks, held evenly, is 9%. And the variance of all those stocks held together is 3.1 times 10 to the negative 4. So Jeffrey, why? Why would I hold all these stocks evenly? 3.05 times 10 to the negative 4 risk when I could just buy the S&P 500 and only pay 2.3 times 10 to the negative 4 in risk. Well, I don't know. Maybe the expected return is less, or maybe actually you would be better off buying the S&P 500 because the S&P 500 is equity market capitalization weighted. Oh, that's complicated, Jeffrey. What the hell does that mean? Equity market capitalization means that we hold the stocks based on the value of the company's equity. So if we hold 100 stocks, we calculate the total market value of the 100 stocks, then buy and hold each stock as a percentage of the total market capitalization. In this way, we hold more of the more valuable stocks. Okay. That actually has worked to reduce your risk in the market. This has reduced investor risk relative to investor returns for years. It's a good thing. It's why people invest in the S&P 500. That market cap weighting is valuable. We could market cap weight our portfolio upon client request. It would require some more coding, and you do get a little bit of an error because our market data provider, Intrinio, sometimes makes a mistake. Sometimes the data, it's not even they make a mistake. Sometimes the data as it's reported is missing a few zeros. So $1 billion market cap shows up as 10,000 or 100,000 or 1 million or 10 million. And so you make mistakes. I avoid those mistakes, but I lose some of the value of market cap weighting. So that is one of the things that we could do. We could market cap weight our model. Would require a little more processing power and a lot more coding, but I'd be willing to do it. So let's talk about where we are. So if you could only buy one stock, what stock would it be? It would be P&M Resources, because that is the only stock that has a greater risk-return trade-off than all the stocks held together. Every other stock is worse than just buying the market. So that's a risk-off market. That's something to take care and think about. Now, let's say you still wanted to hold stocks. Jeffrey, I'm not going to buy New Mexico's regulated utility with a 3% dividend yield, a stock that has gone up 600% since 2008, the financial crisis. I would have made 600% of my money. That's pretty good. I don't make that on my house. My house isn't worth 600%. But if I would have bought P&M Resources, I'd have made a lot of money. So maybe it is good. But that's not the point. Jeffrey, I don't want to do that. That's not fun for me. I'm going to put the money in there and I'm going to go to sleep. 6 years later, I'm going to be making a ton of money, but I'm taking very little risk. There's people that want that. You buy a run, you talk to me, I'm going to give you those stocks, and then you're going to, expect to make a lot of money with very little risk. That's good. MoneyGram. So sending money to people, that feels like a play on the underbanked, on the underside, in a way, of our economy. Stocks like U-Haul, pawn shops, right? So when the pawn shops and the money senders are at the top of our list, there's risk off. There's some others. Berkshire Hathaway, the ultimate. It's just like an S&P 500. It's an insurance company that invests in stocks, and so you invest in them to get the stocks that they invest in. That's fine. Illinois Tool Works is pretty low risk. They make tools. Royal Bank of Canada has historically been a very low risk, along with Sun Life Financial, because there's 5 banks in Canada, big banks in Canada, that are very focused on not making waves. Then you have Pepsi and Coke, Thomson Reuters, which charges a lot of money for market data services. I would be surprised they ever go down. You see what's up here, right? Marsh & McLennan, an insurance broker. Johnson & Johnson, a pharmaceutical company, very large. It also makes consumer products. Honeywell, large industrial firm. Mondelez, food products. I don't know if they make Oreos, but they might. Or Chips Ahoy. And Oreos, They're flying off the shelf at our local Jewel for 3 packages for $10. Those packages used to be $1 or $1.50. So they've doubled or tripled their prices, and they're selling them like hotcakes. Oreos never go out of season. McDonald's, because if you need a fast meal, Lincoln Electric, Willis Towers is a... Well, oh my God, Willis Towers. Well, the Willis... I thought they were insurance brokers. If that's the case, then it looks a lot like Marsh & McLennan. So these are very low risk. Bank of Montreal is one of the 5. CGI is a Canadian IT provider. ADP, Automatic Data Processing. Lowe's Corporation, big retailer. Paychex, business to business. Accenture, business to business. One of the 5 Canadian banks, Bank of Nova Scotia. Yum Brands, which is Taco Bell, Pizza Hut, companies like that. KFC. So that's like McDonald's. So you can see very low risk. So sure, you can buy consumer discretionary, low risk, cyclical stocks that are not going to move much. The worst stocks, the absolute dog star garbage, Carvana. Madrigal Pharmaceutical, which is up a lot. It's not to say it's not going to keep going up, but it's tremendously high risk for the return. Upstart. AMC, the movie company, is an exceptionally terrible risk to take in this market. Farfetch, Cassava Sciences, Snap. Then you have Canopy Growth, which is a pot stock. WeWork. I don't know if anyone's really looking to rent a whole bunch of office space in this market. There's an AI company. There's Lyft. You need a Lyft? I usually Uber it. Coinbase, for those who like to invest in Bitcoin and other fake money. DraftKings, GameStop. You can see these are very high risk, and what you would see if you looked is they have a low expected return, they're very high risk. They're stocks that you play just because they move a lot. Well, we don't target our model to that, and so those are the worst stocks, the stocks you stay away from because they move but they don't go up. But some people like that. Now, when you look at the stocks that we pick in our model, I'm going to show you the little bit of inside baseball. So ultimately, there's one portfolio. But we run a bunch of different solvers to get to that one portfolio. So what we're doing is we're looking at 2,143 stocks, which the math would be 2,000. It would be 2 to the 2,143rd power minus, I think, 2,143. So you've got every stock could be held with every other stock. There's a lot of combinations, right? And so we come up with solvers that it's like climbing up a hill or climbing down a hill. You try every footstep, right? You're going down a hill. You're looking for the lowest part of the valley. So you start at the top of the valley, the mountain, and you go left, right, front, back. Oh, I made it down. Okay, and then go again. Left, right, front, back. Oh, I made it down. Left, right, front, back. Oh, I made it down. And you keep taking steps until, oh, I didn't get any better. Stop. Go up a step. Go a different way. And so you're constantly looking into your local minima to find a good answer. And your genetic algorithms do that, but the way that we coded ours is that it also looks a little bit farther away, not much farther. We used to have it where it looked on the other side of the mountain, right? It just took a lot of capacity. This was at a time when our model was pretty flush. I'm actually going to make a note. Look over the mountain more with our genetic algorithm. So this one's just more looking like close. Like, oh, let's look over there. And we have two different genetic algorithms we run. We have a fast and a slow. One came up with 59 stocks, one came up with 55 stocks. Then we have our simulated annealer, which is also looking in the neighborhood. This one says, is there a path that's absolutely better? Take it. If there's a path that's a little worse, take it anyway. At least in the beginning, when the temperature's hot. So in the beginning, look all over the mountain. By the way, at the end, just stay where you are and only make incrementally better steps. But in the beginning, feel free to run all over the mountain. Even if it's not better, even if you have to go up to go down, just try it. Try it. And this one, 52 stocks, 60 stocks, you'll see that that's actually the best answer, right? Simulated annealer that was coded by yours truly with our team. Now we have our unseeded Monte Carlo, or our truly random bets. We started a 79 stock portfolio, just random. And then the best answer was a 16 stock portfolio right here. Just random, just roll the dice, right? Seeded Monte Carlo, which is take the best CQNS solutions and run them. Doesn't take very long. You get a pretty good answer, actually. 30 stocks. Then we look at the best betas, the highest betas, and we say run those. That's a risk-on kind of a model. We're going to add to our model low beta. Run it with the risk-off stocks and see what happens, because we're running risk-on stocks. And this also actually gave you a pretty crappy answer. But then we run through a simulated annealer on the answer, and we do better. And then we did a particle swarm optimization model, which it's super fast. Not the best answers, though. Not terrible. Not terrible. Not great, super fast. Now, if you're going to take in all these great solutions and try to find the best answer out of the best answers, then sometimes you need different good answers to be able to slam together, genetically algorithm, what am I thinking of? You want to evolve the portfolios. It's not bad. You need them. Now, we ran the D-Wave simulated annealer, which is Python code that runs classically. That did pretty well, actually. Took a really long time, though. Holy cow. Holy cow, Batman. That took a long time. And then the second time we ran it, it unfortunately defaulted to a one stock solution. Takes a very long time. So we're going to have to figure out how to run that a little faster, because I don't know. Then we have a bespoke simulated bifurcator, which is a lot like the Toshiba simulated bifurcator, but this is based on the original Japanese research article that Toshiba then also used to build theirs. This is not Toshiba's code. This is our code based on that article, and I want to thank Dr. Clark Alexander for actually doing the code. Appreciate it. Good job there. Terrible answer, though. Terrible answers. This simulated bifurcator is not working right now, but that's okay. We ran it a bunch of times, and it is just excuse my language, not a very good solver. Okay, that was a very nice language. I didn't use any bad language, so don't call the censors on me. All right, then we reverse simulated anneal the whole thing. So we take the best answer, and then we start cold and end hot. We focus on, is there a better answer right here? And then we spread out. We spread our view. Not really better. And then we run a genetic algorithm with the 20 best portfolios. It never found a better answer. So, net, the solution is 49 stocks. You have to hold 49 stocks. I'm going to vomit. Do you know how hard it is to manage 49 stocks every day? I mean, it's nice as you're going to get dividends. It's not going to really go down very much, but this portfolio is probably going to earn you, I'm going to guess, around 10% return, which isn't bad. It's going to be exceptionally low risk. It's going to pay dividends. Maybe that's not such a bad idea. It's just not a get-rich-quick scheme at all. It's a slow and steady wins the race kind of a portfolio. And to be honest, maybe that's the solution. Maybe that's where we need to go. Because when you're risk off, you got to hold a lot of stock. So what we could do, we could try to maybe market cap weight this thing. We could do a low beta solver. We could search deeper into the mountain. But I don't know that any of that's going to matter. So the other thing you could look at positive skew stocks. You could look at negative skew stocks. You could look at leptokurtic stocks. You could look at platykurtic stocks. You could look at all kinds of different filters that we actually run every time we have a client that asks for the model. And we also post them on occasion on our website. So many solutions. Part of the thing about running a model like this is there's so much data that you really have to be kind of clear-headed on what you're looking for, right? I'm sorry you have to see all this. You're probably having like an epileptic seizure right now, right? That's not a helpful thing for my clients here. All right. So we'll go back to the best solutions. Again, PNM Resources, MoneyGram, Tower Semiconductor, Berkshire Hathaway, Carl Icahn's IEP, the worst ones. But what else, Jeffrey, do you have for me? These are all kinds of data on those stocks, 2,143 of them. Oh my God, I'm going to be looking at this data all day. I'm going to stretch a little bit. This is why I do a spreadsheet, because some people just want to look at the spreadsheet. They're like, Jeff, give me the data in the spreadsheet, because this is crazy. How am I going to look at all this text? And you know, you're probably right. Probably right. Okay, who paid a hot dividend last year? Now, some of these, it's a one-off dividend, so you can't trust it. But look at these dividends. Albertsons Company paid a dividend. I think they spun off something. Bulk Carriers, Integrated Shipping, Golden Ocean. So those are companies that made so much money shipping goods that they paid out dividends so that they wouldn't waste the money. European Wax Center paid a 17% dividend. Oh my God. Who knew that beauty paid so well? I never knew. You know, there's a European Wax Center by us here in Deerfield, Illinois, and I almost walked in. I was going to ask, how much does it cost to wax my entire body, including my eyebrows? But then I thought to myself, that's a really weird thing because I've never had any waxing done. So instead, I'm just going to drive by on my way to Woodman's, and I'm going to talk about the funny things that I could say to the European Wax Center people. But it's a real company, and they really do like the waxing. They got a Tricosi beauty training schools that do kind of the same thing, but these guys, like Soul Focus, they're going to wax poetic. It's great. So what else we got, though? What big dividends? We got Chimera Investment Corp. Ooh, Chimera. That sounds like fun. Storm Ruger and Company. Guns. I guess you got to pay out the dividends because when you get sued, they take everything, right? So pay it out. I bet you the tobacco companies also have pretty high dividends because they don't want the money. They want you to have the money as shareholders. Crestwood Equity Partners. That's, there's a whole bunch of these. See where it says LP? Limited Partnership? Those are stocks that often will hold capital assets that pay off dividends. And as a master limited partnership, a limited partnership that trades on a stock market, it has interesting tax treatment and can offer high dividends in a tax-advantaged way. And so we look at like USA Compression Partners. They have compression equipment, right? Kimball Royalty Partners, I'm not sure what that one does. New Star Energy, Alliance Bernstein Holdings. That's probably more like a hedge fund. One Main Holdings. Okay, Alliance Resource Partners, I think, is coal. Energy Transfer is a big pipeline company. Magellan Midstream Partners is a midstream. Plains All American Pipeline. Sunoco LP is also the pipeline version. Holly Energy, I believe, is also pipeline. Western Midstream Partners, I think, is water and pipeline. And you get my point. So they're in there paying nice dividends. But then you get like Manulife Financial, right? Big insurer. Bank of Nova Scotia. New York Community Bank. Good dividends. Good dividends. I mean, I don't know right now that I'm buying dividends. Because as interest rates go up, dividends are worth less. And so each of these stocks could go down as the value of the future stream of dividends goes down. So that's interesting. So let's take a look. So now I've got negative beta stocks. I got U-Haul. U-Haul is the ultimate in negative beta stocks right now. So for the past year against the S&P 500, it moves 127% the opposite direction of the S&P 500. It is truly the opposite. That's interesting. U-Haul, maybe it's a hedge against the S&P 500, right? Maybe as the economy fails, people pack up their stuff, throw it in a U-Haul, and move across country. Save some money. You know, I hear that rents are low in certain parts of the country versus, let's say, New York, Chicago, LA, San Francisco. So, you know, you don't have a lot of money. You maybe got enough for a U-Haul. You throw your stuff in a U-Haul and you move to where it's cheaper. That feels like a negative beta type of a situation where it does well when the economy does badly. The other two, I don't know. I don't know why they would have negative betas. These stocks rose in price really fast. These stocks fell in price really fast. So if you're looking for stocks that have gone up or have gone down, that's interesting. Here are stocks with one-day price spikes, meaning they've traded a lot of stocks in the last year in one day. Zynga, Tower Semiconductor, Travel Centers of America, you know, the truck stops. Old National Bancorp. Do you know they just opened up a branch in Deerfield? They traded 29 times average annual shares traded in one day in the past year. MoneyGram traded 45 times. So, Frontier Communications, either somebody's taken a position, or the memers are coming, the people that want to paint the tape are coming, or maybe a large investor sold their stake, or maybe a large investor took a large stake, or maybe there was news and they just said, you know what, we're going to go crazy. There was a big surprise, big earnings, big losses, acquisition, whatever. But those traded, so you could look at those and say, maybe if I saw that a stock was being acquired, especially stock under $1, and huge positions were taken, and maybe they're going to pop up higher. And these are stocks that split. What's interesting is it's a tale of two cities here, because some of the stocks that split, Tesla, these are high flyers. NASDAQ, Alphabet, Amazon. Other stocks that split, AMC spun off a business. General Electric, not necessarily your high flyers. AT&T. But they spun off parts of their business. Separate stocks. And then some of them where it's greater than one, like PaySafe Limited, Two Harbors Investment Corp., those are reverse splits, Digital Bridge. And a reverse split reduces the number of shares and increases the share price because you have to trade at $1 a share to stay listed on a NASDAQ exchange. So let's go back to the very beginning and the premise of this video. Forge your investing skills. Understand that right now it is a risk-off situation. And so the first thing that you should be thinking if you want to kind of keep up with the market is that the best performing stocks right now, for the most part, are those paying a dividend. Well, Jeffrey, I don't know that that makes sense. It does. So they pay a dividend. They don't move very much. They're paying out cash. It's nice, right? You get money. They maybe don't move as much. Most of the stocks that are at the top of our list have a positive dividend, something over 100%. So I'm going to do a conditional highlighting and I'm going to show you. Here are the stocks greater than 100%. Green fill. Done. Uh-oh. Add a rule. Greater than 100%. Green fill. Done. No. 1. That's fine. Oh, I like green fill actually better. All right, here you go. All those stocks have a dividend. So the model loves high dividend stocks because those dividends have been dampening the volatility or variance. That's cool. Got it, Jeff. High dividend stocks, model loves them. What else does the model love? The model loves a 29 stock portfolio. I'm sorry, 49 stock portfolio. Here it is. That's a lot of stocks. So, when we were running a model when the market was going up, we'd get 2 or 3 stocks, right? You put your money in, you'd make like 20% in a week. This is more of a 10% a year kind of a return, but with a sweet dividend. Maybe that's okay. And so you have to really think about it, right? So right now we are not making speculative trades in the stock market. We follow the market. We do. We look, we watch, but we don't trade it. And the reason is that it's odd what we see. So we created a thing called holdings. And let's look at our we look at B2B tech. B2B tech was down on Friday, but it's actually hard to track. It's not really something that's helping us, right? Trucking and transports. So you can look at different markets. You can look at leptocurtic stocks. Somehow leptocurtic stocks did great, right, on Friday. Why? I don't know. Platycurtic stocks. What we know is that, look at that. Almost every platycurtic stock went up on Friday. So you know what that is? That's risk off. Platycurtic stocks don't have any readings in the tail. What do I mean by that? Share a little math. A standard deviation is like an amount that you would expect a random variable to move. And 2 standard deviations gets you about 96% of all of the next random moves. 3 standard deviation is like 99.5%. So 995 out of 1,000 readings are going to be within 3 standard deviations. Platycurtic says that most of your readings are going to be within like 2 standard deviations. They're going to be closer to the mean. You're not going to get a lot of surprises. We also make them low variance. So not a lot of risk anyway. Not a lot of chance for surprises. Pretty big market caps. If you look, 242 billion. Almost every one of them is over $1 billion, right? And pretty much all of them went up. So wow, is that great, right? What a great idea, Jeff. I could be in negative risk stocks and make money when the market goes down. That's the point. Risk off. Find stocks that are risk off. Take a shot at them, right? Now, your leptokurtic stocks, to see how this is actually maybe not so clear. Leptokurtic stocks, remember we talked about standard deviations, right? So you get like 66% of your readings within one standard deviation. So a leptokurtic stock has more answers, more of your next random, hey, how much did the stock go up or down? Closer to the mean, closer to the expected one. So within the 33, within the one standard deviation. But it also has a lot more chances. It may be more than 5 in 1,000, whereas platykurtic went from 5 out of 1,000 to maybe 1 out of 1,000. Maybe leptokurtic goes, I'm going to go crazy 3 standard deviation, not 5 out of 1,000, but maybe 50 out of 1,000, 100 out of 1,000. 10 out of 1,000. It's going to really be a chance for a big move. But they're also low variance. And so these are low risk, but a good chance of surprise. These stocks also went up at a day when the market went down. So the real question is it just low variance? Did the market love low variance on Friday? Did people rotate out of sectors that were risky into low risk? So let's take a look. What do I have in my reads that are high risk? Well, the one that is the most high risk is high beta, because those are systematically risky. Those went down. Not all of them, though, right? But those went down. You look at the median read, it's about minus 3%. So, yeah. You still could have made money on Mara or Carvana or Riot. Right, so some Bitcoin and used car salesman. But for the most part, you lost money, right? And so Friday was proof positive that the market was risk off and that you made money by investing in 49 stocks evenly held. And that on Monday, or let's say next week, this week, Tuesday through Friday, you should be holding 49 stocks evenly held, or maybe market cap weight them. And you should look to low risk stocks if you're going to make investments in individual stocks, but you're a little late because the smart money already got in on Friday. If you're watching the video, you're like, oh, hey, Jeff, I wish I would have known this 3 weeks ago. Well, you would have. If you follow our videos, you would have seen that we have been posting risk off for quite a while now. Let's see how far back. Risk off. So on the 8th, we were risk off. Yeah, that's when we really started. So on February 8th, you could have started getting into some of those risk off stocks. We were risk off on the 8th, the 10th, the 13th, the 14th, the 15th, the 17th. And now today on the 20th. And so we gave you 12 days notice. Go risk off. Now, who knows? We could be risk off for a week. We could be risk off for a month. We could be risk off for a year. So I posted a picture on Twitter of the S&P 500 trend. See if I can recreate that chart. Yes, I can. If you look at the S&P, maybe. Maybe. Let's take a look. Can I really get it? Can I get you that edge that you're really looking for? So if you look at the bottom of the line here, you can see you're running down to like, this market should be trading at around 3,500 at the low end. And we're high, but if you connect the closing prices at the high end, this might actually need to come down a little. I'm okay to do it here. So what happens, what you see is that the market is trading up above this straight line. Now, drawing lines on a chart doesn't guarantee you're going to make money, but it does give you a point of view. And I made a really funny tweet that nobody likes. I said, this is a tiny baby's burp in the market. It's a burp. It's a tiny nothing. It's not a crash. It's a burp. And to be honest with you, another 5 or 10% burp wouldn't surprise us. Now, that's not really a burp. That's a greps. That's almost a vomit when it falls 10%, right? But take a look. You've got a market that is trading really above where it needs to go. And so if I were to draw you some dotted line here, I wouldn't be surprised if this market comes back at least to this line. I don't know. You got to feel it a little bit, right? And so we've had some news that's been bad. We had inflation news, right? So in general, this is where I think we are. I think we are risk off. And I think when the market corrects, then there's a chance to pop up again. Look at these pops we had. 1, 2, 3. Market likes to recover. 4. Although the slope of the recovery seems to be slowing, 1, 2, 3, 4, 5, 6, you've had 6 recoveries. I mean, buy the dip, right? Buy the dip. Make money. But I still see the red line as being where we're headed. And so, risk off. Risk off. Risk off. 12 days we've been calling it. We're still there. Good luck in the markets. If you like the video, we're not paid to make the videos. We make them to share our knowledge with you and to give us some good ideas so we can recode our model and learn even more, right? And so I just wrote down 2 things that are pretty cool, but based on talking to you all. So please do me a favor, though. Subscribe. Our channel on YouTube, I am Jeffrey Cohen is the handle. It's US Advanced Computing Infrastructures, Inc. Just hit the subscribe button. If you like the video, give it a thumbs up, drop a comment. I'll answer all of your comments. And maybe let somebody know that you like the video. All right. Thank you very much for watching. You take care now. Have a great weekend. Or have a great President's Day. Bye-bye.